Hey guys, welcome back to the channel, best place for long-term stock investors. Today we are starting a new series, you can say, where we will share our thoughts on the 3 best and 3 worst performing stocks in the month, right? And this time it will be August. Now, as a disclaimer, we do not own any of the shares that we will be mentioning, and we are not financial advisors. So if you need that sort of advice, please speak to a professional. What we say is purely educational. Before we move on, guys, just to let you know, we have a masterclass, free, absolutely free, for you to try on, which you can find in the comment section or the description, where you can learn how to build a 6 to 7 figure portfolio using the power of stock investing. So if that's something that interests you, please go and sign up. Okay, so just maybe since the first one, we will give you a brief format, right? We will be looking at the quarterlies for that month. Maybe next time we can look at share price instead as well. Now, we will be picking what we think are the 3 best and 3 worst performing companies year on year. We'll share with you our thoughts, right? And August is a really busy month because it's measuring what's happening in the quote-unquote second quarter, which ends on June, right? It takes about 2 months to produce a quarterly report, give or take.
Yeah, and it's crazy. There's about 400 over companies that's reported.
That's half the stock market.
It's
right?
a super busy month for analysts also.
Indeed. So the first one is LFE Corporation, 80 million market cap. And year on year, it's down. What is down? 5,766.
Okay, so this is the earnings. Earnings that is down.
Okay.
If you compare to the year after before 2011.
So what in the world does LFE Corporation do?
Okay, so LFE Corporation Bhd is a construction company. So what they do is they do building construction service, mechanical and electrical works. Pretty standard kind of business model, very cyclical also. And what they have actually reported is that their revenue is up about 20%, but the cost of goods sold is actually up 52%. And the reason why there's such a mismatch between both of these growth rates, because the management did stated that there's a slow progress in claiming in certain projects. So there's this project that they are currently building. The project is called ARA3. ARA3 is basically a project that's located in Ara Damansara, and it's like a condominium or service apartment kind of like project. So they did not manage to claim some of the money that they actually built for that particular
Very
project.
standard for this sort of construction companies.
Yeah, and I think one of the reasons why costs also have been increasing, maybe I'm not sure, maybe I may be wrong. Maybe it's the building material also has been rising, but you can argue that they actually have been building these projects way back before the inflation actually hits.
Right.
But that is just a speculation from me.
Yeah.
And this company, surprisingly, is a net cash company, construction company, net cash.
Interesting, right?
And it's 38% of the market cap. That's their net cash value is 38%.
But you're saying here a big chunk of it is because they raise rights issue, right?
Exactly.
So this is an important point because I think a lot of first-time investors, when they learn about investing, they want net cash companies, right? Which is a good thing. But you need to know where the cash came from as well.
Yeah, exactly. Is it from operation or raise money? And in this case, they actually raise a rights issue. And the reason why they actually raise this fund is because they are actually incurring a negative cash flow. So they have to finance these fluctuations of working capital. Yeah, and the last point that the management did mention is that they are actually planning to joint venture with one of the property development companies to build landed houses in Kedah. So other than doing construction services, they plan to venture into property development. So that is LFE Corp.
It's a company that has done so-called poorly, right?
Yeah.
But hopefully some of these new ventures will turn things around.
Yep. Okay, so the second
one is Sersol Bhd, 65 million market cap. Wow. Okay.
Yeah, and it's also down about 5,000 over percent.
In earnings. Okay.
Yes.
What do they do?
Okay, so this is also another very quite simple business model. Do you know Nippon Paint?
Of course.
The paint. Yeah. So basically, this is something what they do. They do plastic and metal coating. for the electronic and electric industry, and also sometimes they also do like trading of like materials of like finished wall surfaces and even medical devices. So that's their business model. And so according to their financials, their revenue actually improved about 7%. However, all of the costs actually increase more than the revenue growth. So their costs actually increased to 22%. Their OPEX increased even massive. Yeah, it's like 69%. And the reason why the OPEX actually increased so much is because they actually did a corporate exercise again. And what corporate exercise is, they basically did like a private placement.
Right.
And which resulted them to have like a net cash also. Yeah. Another kind of like non-operational results kind of net cash, producing net cash.
Yeah, so I mean, when you have negative cash flow, but you have net cash, right?
Yeah. Something's wrong.
Okay.
So that's the third company. And
Parkwood Holdings, okay.
Yes, Parkwood Holdings.
Sounds like a Singaporean company, but okay.
Oh, yeah. Okay,
all right, it's down, what, 4,800%?
Yes.
Not so bad.
Yeah,
36 million,
yeah, still quite a huge chunk. So Parkwood business model is what they do is property development and property investment in PJ. But this case is actually pretty interesting because their revenue actually down 33%. Sales is not doing well. Their OPEX also was down about 13%.
Okay.
So revenue was lower than the downward fall of OPEX. So this is actually pretty interesting.
So it's a reverse. It's like a somewhat reverse situation.
Correct. So what this actually tells us is that they have spent a lot of maybe their marketing costs and sales costs that they actually spend cannot cover the sales generated. Yeah. So that is the one thing that you can derive from these numbers. And another company that did right issue and which have net cash. I mean, you can see this kind of companies. You can see a correlation.
And then also another one I can see is that, there's a shortage of labor for, labor. Even the first company that you mentioned.
Yes, exactly.
So that is, man, that is good insights.
Yes, exactly. And this skilled labor is actually in the property development. So you can imagine like not only like in the engineering, like the tech sector, everywhere, basically everywhere. Yeah. So that is the third last company that is performing the worst.
All right, guys, before we move on, just to let you know, we have a one-on-one mentorship program just for you. If you're interested, you can apply for it. In this mentorship, it's going to be, as I said, a one-on-one session built just for you to improve your stock investing level. Now, not every one of you all get in. Only 20% of you all are accepted into an interview, and even fewer of you will end up hopping onto the program. But if you're positive and you're confident that you can qualify for it, just apply. It's in the comments and the description. All right, Jonathan, let's look at the more positive side of things.
Yep.
Right? The best companies year on year.
Sure.
Number one is Focus Point. Spectacles up 18,000%.
Yeah, 18x, and they are currently at a 200 million market cap.
They are a small cap.
Yeah, pretty small cap. And so if you don't know what's their business, what they do is basically they sell specs, optical related products. And on the side business, they actually do like a F&B, specifically bakery. I think just now you mentioned the brand name.
Komugi.
Yeah, Komugi. Yeah, exactly. So it's like how I actually see is, I think it's like a premium kind of like a bread. Right?
Yeah, I tried, I think 20 items. 10 of them taste pretty good. The other 10 is 50-50.
Okay, so this side business actually contributes about 15% of their revenue,
right?
And a huge chunk of the revenue actually comes from their optical related products. And if you notice why they are actually up like about 18x, right, year on year, is because it's contributed by their sales. Right. So their sales almost like double. Up over 90%, and they only spend a very little bit on marketing costs, which is their OPEX only up like 37%. So that's actually pretty impressive. Right. I don't know. I think this indirectly tells us that more people are actually buying spectacles in a way. Yeah. And this is a net debt company.
Yep.
I was actually quite curious. I thought they were actually spending their centers, their specs, or maybe even their bakery centers, right? But what I found out is that 90% of their debts were actually from short term.
So most likely it's working capital, maybe as a result of the COVID crackdown.
Yeah, it could be, but all the while he has been 90% even before prior to COVID.
Okay, so it's just a capital allocation strategy.
Yeah, correct. Okay. So, but then their cash flow is like pretty positive.
Yeah, that's why they can have a lot of short-term debt.
Right.
So this is another key interesting point, right? Like Generally speaking, 9% short term debt should alarm people.
Yep.
But you also need to look at how big the debt is in relation to the assets and also in relation to the cash flow. If the cash flow is very good, then it doesn't really matter even if you're net debt.
Yep.
Right.
So yeah, that's the interesting fact. And the last point is basically why their sales actually been so good, right? Is because there's actually a rising footfall in malls. So that is basically the conclusion that we can see in Focus Point.
Yeah.
Then the next company you're going to be looking at
Hong
is
Seng.
Yes, Hong Seng Consolidated. I think this has been a stock that most retail actually pay attention to. I believe it was in 2021. There was actually like a huge spike. I cannot remember what's the details, but if I were to speculate, I think it's something to do with their glove or logistic business. Yeah, I can't really remember.
Right.
Yeah.
And to be clear, this is 2.5 billion, right?
Yes,
the company.
2.5
So it's a
billion.
big company. Okay.
Yeah, and they are up about 20x.
Yeah.
So what they actually do, they did a bunch of stuff. Later I'm going to tell you what a lot of stuff they actually did. But this is actually quite a new business segment they are in the healthcare. Because initially in 2019, 2020, there isn't this healthcare business. They were doing like a logistic kind of services. And all of a sudden in 2021, they did healthcare. And the healthcare business is basically they do like COVID-19 checkup and lab test result.
Right.
And then they have like another business segment, which is like a e-medicine. So what is this e-medic business segment, right? Is the doctors are actually doing e-consultation for their patient. So I believe this was done because there's like COVID-19. So they don't want to have like a face-to-face interaction, right? Physical interaction. So they do like a kind of like a virtual kind of meeting. You meet with the doctor virtually, and then the doctor will diagnose your whatever symptom you have virtually, and then they will issue what sort of medicine, and then the medicine will actually transport it to your house. So everything is done without any physical contact.
I see.
So I think this is another thing that we can look at is their financials. Even though they are up 20x, right? You notice that their sales are actually down 14%.
Yes, which is why I want to ask you where is the net income coming from?
So actually, majority is coming from the other income segment. So if you notice at this slide here, I put over here. So there's this other income, right? They actually made about 21 million. Yeah. And that 21 million is actually more than their 6 million in revenue.
Yeah.
So reason why is because they actually dispose of a subsidiary, one of the asset core business, I believe. And which is the reason why their earnings actually gone up by 2,000%. Yeah. And this is a company also is a net cash, but the interesting part is that they raise two things. Rights issue and private placement. And it's a negative cash flow kind of company. And also they are starting to becoming like a conglomerate. So this is a company that I will say that I don't want to use the word, but FOMO.
They're in many different businesses.
Yeah. Initially they weren't, but they were because of this particular trend. So they were initially in the financial services. So financial is basically they do money lending. Then advertising is basically like your online digital marketing kind of services. And then they ventured into glove in 2021.
So one thing I noticed is that they are about 6 billion in sales, so let's say it's 7, right?
Yeah.
So you're looking at nearly 30 million in sales every year if you analyze it. But their market cap is 2.5 billion.
Yeah.
And so what is the price to sales on that? That's like nearly 35 times that.
2 billion, 6. Actually.
Right?
It's pretty ridiculous valuation.
So and then I think if you remove the other income already represents about 2/3 of their sales. So
I'm not sure. And recently they also wanted to venture into EV, like to do assembling for a battery for the electric vehicle.
They are literally everywhere.
So pretty interesting company.
Okay, last one is Bonia. This one I think a little bit more familiar.
Yeah.
Yes, right. It's up 2,500%, give or take. And it's a pretty small company, 460. When we say small, we mean by market cap, right?
Yep. So I think I would kind of associate Bonia with maybe Bhd. It's like a complimentary lah.
Yeah.
Because
Okay.
Bhd is the shirt.
Yeah.
Whereas Bonia is like your accessory, your bags.
Sure,
and shoes.
fair enough.
Yeah. So that is their business model. They sell bags, footwears, and accessories. And the reason why they are year on year has been performing so well is because their revenue actually up about 93%,
Yeah.
which is
And the rest didn't rise as much, right?
Yes, exactly. And they are in a net debt
But it's
position.
minuscule.
Yeah, it's super
small.
minuscule. It's only like 300,000 difference. Positive cash flow, and the reason why they actually have been going up is because of the Hari Raya festive season and also revenge spending.
Standard.
Yeah, so that is a very simple description for Bonia.
Alright guys, before we move on, if you're enjoying the video, remember to give us a like, comment, in the video whether you agree with our analysis, and of course, subscribe. Click on the notification bell so that when new videos pop, you know it fresh. Alright, Jonathan, so I think the big takeaways, I think one is that, profit is profit, cash is cash.
Yep.
They are sometimes the same, but not always the same, right? Especially when you look at big numbers.
Yeah.
That's when you know that there might be dislocation.
Yes.
Right?
There's actually a difference in accounting. I mean, I think we highlighted this a lot in our SIB also.
Yeah, in our SIB program.
Yep.
And in many other previous videos as well.
And the second point is basically the cash that is generated, may not necessarily come from operations. Some may even come from the fundraising from equities. So that is something that you may want to take note of. And the last point that we want to present to you guys is basically the earnings sustainability. Because all of these earnings, there's a huge jump in 20x, even 18x or something like that. Yeah. So you need to know whether is this kind of growth sustainable or not.
Yeah.
Or
And what is the
one-off
cost of it? Yeah, one-off. Revenge spending is somewhat of a one-off.
Yes, exactly. Actually, I would say most of these companies that is actually currently reporting, I think it's kind of like a one-off. I'm not sure about Focus Point. Because Focus Point, there's who's going to be Focus Point competitor is going to be those contact lenses companies, right? Or maybe even those laser companies like Optimax. Yeah. Those kind of things that you need to take note of to know whether their earnings are being protected. Do they have a moat, or can it sustain, or it doesn't sustain in the future? So yeah, that's about it.
All right. Thanks, Jonathan. And guys, hope you enjoyed the video. If you know someone that will find this video useful, please share it with them. And I will, see you in the next video.